Have you ever wondered what happens when a single commodity enters a genuine structural shortage, and a well-managed company positioned right at the center of that supply crisis decides to make a transformational acquisition at exactly the right moment? This is not a theoretical question. This actually happened in 2025, and the results have been nothing short of extraordinary for those paying attention. Pan American Silver Corporation, a Canadian precious metals producer headquartered in Vancouver, has just delivered what appears to be the most compelling mining story of the current decade. As of December 2025, the company's shares have surged approximately 119% year-to-date, decisively outpacing the silver market itself and positioning Pan American as the top-performing silver stock on investing.com. To put this in context, silver bullion itself has more than doubled in 2025, rising from approximately $30 per ounce at the start of the year to above $64 per ounce in early December. Yet Pan American's shares have climbed nearly 2 times that rate of increase. This is not luck. This is the mathematical result of operational leverage, strategic timing, and something most mainstream analysts have completely overlooked. Let me walk you through what actually happened here, because the mechanics are genuinely instructive for understanding how commodity markets work, how institutional capital moves, and why certain companies suddenly become vehicles for explosive returns. I am going to examine the hard data, the strategic decisions, and the underlying fundamentals that explain this remarkable performance. Pan American Silver operates across an impressive geographic footprint. The company controls 10 operating mines distributed throughout Latin America, specifically in Mexico, Peru, Argentina, and Bolivia. This diversification matters because it reduces geopolitical risk and provides operational resilience that single jurisdiction competitors cannot match. The company has been operating in the Americas for over 3 decades, which means they have deep operational relationships, regulatory knowledge, and established infrastructure that junior or newer producers simply do not possess. For 2025, the company guided for silver production of 22 to 22.5 million ounces, positioning it as a Tier 1 silver producer by volume. But here is what separates Pan American from the commodity price followers. They also produce meaningful quantities of gold, which provides a hedge within the portfolio itself. The company also benefits from byproduct metals including copper, zinc, and lead, which means operational cash flow depends on multiple commodity price vectors simultaneously. At the start of 2025, Pan American's share price hovered around $22 to $23 per share, depending on the specific date. The stock had recovered from pandemic lows, but was not in any way considered a breakout candidate. Most precious metals stocks at that point were trading sideways, waiting for either a major catalyst or a fundamental shift in the macroeconomic backdrop. What happened next was both of those things occurring simultaneously. Here is the unusual fact that most financial commentators have failed to emphasize sufficiently. 2025 marked the 5th consecutive year of significant supply deficits in the global silver market. This is not a one-year anomaly. This is a structural, multi-year imbalance between supply and demand that has accumulated into what the Silver Institute projects as a cumulative shortfall exceeding 600 million ounces since 2021. The supply side of the equation has remained relatively flat. Global mine production continues to hover around 813 million ounces annually, with relatively limited growth from major producers. Recycling rates have remained stable, and secondary supply has not expanded meaningfully. In other words, the traditional sources of physical silver in the market have not kept pace with anything resembling explosive growth. The demand side, however, has undergone a dramatic transformation. Industrial demand for silver hit record levels in 2025. The photovoltaic industry alone consumed approximately 234 million ounces in 2025, representing roughly an 18% increase year over year. This is not discretionary demand. Solar panel manufacturing requires silver as a conductive material that cannot easily be substituted. Electric vehicle production consumed approximately 78 million ounces, up around 22% from the prior year. Again, this is embedded in the actual manufacturing process. It is not something manufacturers can simply scale back if prices rise. But here is the truly unusual demand vector that emerged prominently in 2025. Data center infrastructure driven by the artificial intelligence boom. The computing infrastructure required to support large language models, transformer networks, and distributed AI systems consumed an estimated 41 million ounces of silver in 2025, representing roughly a 37% increase from 2024. This demand driver did not exist at any material scale even 3 years ago. This is genuinely new. When you combine structural supply inelasticity with explosive industrial demand growth from 3 separate end-use markets, you create the conditions for what commodity traders call a genuine bull market in the underlying physical metal. Silver was not rising in 2025 because of speculation or retail FOMO. Silver was rising because industrial end users actually needed the metal at any price, because their business models depend on it. In May 2025, Pan American Silver announced what would prove to be a transformational transaction. The company agreed to acquire MAG Silver Corp for approximately $2.1 billion. The deal structure involved $500 million in cash plus 0.755 Pan American shares for each MAG share held, subject to proration adjustments. This represented a premium of roughly 21% to MAG's closing price at the time, and roughly 27% to its 20-day volume-weighted average price as of May 9, 2025. Now, most observers looked at this acquisition and saw a simple consolidation play, the kind of deal where a larger company buys a smaller competitor primarily to eliminate redundancies and combine operations. But this misses the true strategic importance of the transaction. MAG Silver's primary asset was a 44% interest in the Juanicipio mine in Zacatecas, Mexico, operated by Fresnillo, which holds the remaining 56%. Juanicipio is not an average mine. It is an exceptionally high-grade, large-scale silver deposit that represents exactly the type of asset any rational silver producer would want to own during a multi-year supply deficit cycle. The timing of this acquisition proved prescient. The deal closed on September 4, 2025, which means that Pan American captured only 1 month of Juanicipio's contribution in the third quarter. And yet, the company's chief executive officer, Michael Steinman, specifically highlighted that despite this single month of contribution, the Juanicipio asset was already demonstrating significant contributions to silver segment operations and free cash flow generation. What this means is that in the full year 2026, the economic impact of this acquisition will be substantially larger than what was visible in Q3 2025. From an acquisition timing perspective, Pan American bought this asset at a moment when silver supply was genuinely constrained, when industrial demand was accelerating, and before the full market recognition of the structural supply deficit had fully played out in institutional investor positioning. This is the definition of strategic capital deployment. On November 11, 2025, Pan American released unaudited third-quarter results. The numbers were remarkable across every material metric. Attributable revenue hit a record $884.4 million, representing 23.7% growth compared to the prior year quarter's $715 million. This is not margin-neutral growth. This is the type of top-line expansion that occurs when a company benefits from both increased production volumes and substantially higher commodity prices. Net earnings for the quarter reached $169.2 million, translating to earnings per share of approximately 45 cents. When annualized across 4 quarters, this represents roughly $1.80 in earnings power, which is 3 times the comparable quarter from the prior year. The company missed the consensus earnings forecast of 51 cents by approximately 5.88%, which caused some short-term disappointment among analysts. However, This misses the point entirely. Missing a consensus estimate by 3 cents per share when you are delivering 300% year-over-year earnings growth is a matter of minor quarterly timing variance, not a fundamental operational failure. Adjusted earnings per share, a more relevant metric for commodity producers, reached 48 cents in the quarter. Free cash flow generation hit an all-time record of $251.7 million in a single quarter. Operating cash flow from continuing operations reached $323.6 million. These are numbers that reflect a genuinely profitable, cash-generative operation. This is not a company with promising future potential. This is a company that is extracting significant financial returns from its operations right now, in real time, as we speak. Silver production in the quarter reached 5.46 million ounces at a realized price of $39.08 per ounce. Gold production hit 183.5 thousand ounces at a realized price of $3,479 per ounce. The company's all-in sustaining costs, a crucial metric for mining operations, were lowered significantly following the MAG acquisition completion and the integration of Juanicipio's low-cost production profile. Pan American's balance sheet structure as of September 30, 2025, deserves specific attention because it explains how the company can simultaneously return capital to shareholders while funding exploration, development, and strategic acquisitions. The company maintained cash and short-term investments of $910.8 million, plus an additional $85.8 million of cash attributable to the Juanicipio joint venture. This provides a liquidity buffer of approximately $996 million. The current ratio, measuring liquid assets against current liabilities, stood at 2.5x, which indicates the company could cover its short-term obligations 2.5 times over. This is fortress-level balance sheet health. Debt to equity stood at just 17.6%, meaning the company is financed primarily through equity rather than leverage. This is crucial during commodity cycles because it means Pan American has substantial capacity to weather price downturns or deploy capital into growth opportunities without constraining operating flexibility. Many junior and intermediate producers operate with debt-to-equity ratios of 30 to 50%, which limits their strategic flexibility. Pan American's conservative leverage position is a competitive advantage that most investors fail to properly value. In a move that reflected confidence in both operational trajectory and commodity price assumptions, Pan American's board of directors approved a dividend increase to 14 cents per share for the third quarter of 2025. This represented a 16.7% increase from the previous quarterly dividend of 12 cents per share. The increase was announced on November 12, 2025, with payment scheduled for December 5, 2025, to shareholders of record as of November 24. The dividend yield at current stock prices represents approximately 2% on an annualized basis, which is meaningful for a growth-oriented commodity producer. More importantly, the dividend increase demonstrates management's confidence that the operational cash flows supporting the higher payout will continue or expand going forward. Mining company dividend decisions are not discretionary marketing tactics. They are explicit statements about cash generation expectations for quarters to come. During the third quarter alone, Pan American paid out $43.4 million in aggregate cash dividends to shareholders. Year-to-date through the third quarter, capital returns to shareholders through dividends and share repurchases reached $146.9 million. That is capital flowing back to shareholders while the company still maintains nearly $1 billion in liquidity. This is the hallmark of a cash-generative business in a favorable commodity cycle. One of the least discussed but most important developments in 2025 has been the movement of institutional capital into Pan American Silver. Between July and September 2025, Van Eck Associates Corporation increased its position in Pan American by 51.8%, ultimately accumulating 45.1 million shares valued at approximately $1.748 billion as of the third quarter. This is one of the largest precious metals-focused asset managers in the world, deciding to dramatically increase exposure to a single silver producer. Vanguard Group also expanded its Pan-American position by 21.2% during the third quarter, reaching a holding of 17.2 million shares, valued at approximately $666 million. Mirae Asset Global ETF's holdings increased its position by 38.7% in the third quarter, ultimately accumulating 14.5 million shares. Invesco raised its position by 9.8%, acquiring 882,000 additional shares during the same period. What these institutional flows represent is not speculation by retail investors or momentum chasers. These are multi-billion-dollar asset managers making deliberate allocation decisions based on fundamental analysis of supply-demand dynamics, commodity price trends, and company-specific catalysts. When Van Eck increases a position by 51.8% in a single quarter, that is the institutional market telling you that this security deserves a substantially larger weighting in the precious metals allocation. In December 2025, Pan American released a comprehensive year-end exploration update covering drilling activity between November 2024 and October 2025. The company completed 333,830 meters of drilling across its key properties, representing 70% of its total planned drilling activity during the period. Specific exploration focus areas included the Jacobina mine in Brazil, El Peñón in Chile, La Colorada in Mexico, Huaron in Peru, the Timmins region in Canada, Minera Florida in Argentina, and Cerro Moro in Argentina. The exploration update outlined promising results in terms of extending mineralization, identifying new targets, and confirming resource estimates at existing mines. The strategic intent behind this aggressive drilling program is to extend reserve life and ensure the company has a multi-decade pipeline of ore bodies to process. Most mining investors understand that reserve replacement is essential for long-term sustainability, but relatively few recognize that during commodity booms, the companies that invest most aggressively in reserve replacement tend to outperform most dramatically in subsequent years. For 2025, Pan American planned approximately 540,000 meters of total drilling across its portfolio. This represents an aggressive exploration budget that signals management's intention to convert mineral resources into proven and probable reserves, ultimately extending mine life across the portfolio. In a move that demonstrates management's willingness to deploy excess capital into earlier-stage exploration and development opportunities, Pan American recently acquired a significant stake in Galleon Gold Corp., a junior explorer focused on gold and silver projects in the Timmins region of Ontario, Canada. The company acquired 18.75 million units of Galleon Gold at Canadian 60 cents per unit through a private placement. Each unit consisted of one common share plus one warrant. This investment represents both a geographic expansion of Pan American's exploration footprint into Canada and a strategic bet on the future value appreciation of earlier-stage assets. During commodity booms, larger, cash-generative producers often acquire meaningful stakes in junior explorers, essentially making venture-style bets on the possibility that drilling will identify economic deposits. If successful, Pan American would have first-look rights or other preferential acquisition terms for any economic discoveries. Following the Q3 2025 results release and the subsequent rally in silver prices, multiple analysts raised their price targets on Pan American Silver. Bank of America increased its target price from $46 to $51 per share. CIBC Capital Markets lifted its price objective from $50 to $62 per share and reiterated an outperformer rating. National Bank Financial upgraded the stock to a strong buy rating. The consensus among analysts covering the stock, as of December 2025, stands at approximately $48.18 per share, representing 26% upside from prices around $38 per share in late November 2025. The broader consensus estimate for 2025 earnings per share stands at $2.16, while estimates for 2026 have been revised upward to approximately $3.37 to $3.45 per share, implying 56% further earnings growth in 2026 compared to 2025. Forward earnings per share for 2026 stands at approximately 74 cents per quarter, which translates to a forward price-to-earnings ratio of around 13.5x at current stock prices. This valuation is substantially below the 17.4x average for the silver mining sector and below the broader precious metals mining industry median of 17.43x. In other words, even after the 119% year-to-date rally, Pan American trades at a modest valuation relative to its earnings growth trajectory. Understanding Pan American's exceptional performance in 2025 requires recognizing several unusual macroeconomic conditions that prevailed throughout the year. First, real yields on risk-free assets moved into negative territory. The Federal Reserve, concerned about economic growth deceleration and labor market softening, cut interest rates 4 times during 2025, reducing the federal funds rate from approximately 4.25% to 3.75% by mid-December. When the real yield on 10-year Treasury securities moved to negative 0.3%, the opportunity cost of holding non-yielding assets like precious metals declined substantially. Historically, silver performs best when real yields are negative, averaging annual gains of approximately 28% per year in such environments over the past 4 decades. Second, geopolitical uncertainty remained elevated throughout 2025. Trade tensions between the United States and China, political transitions in Europe, and regional conflicts continued to elevate demand for safe haven assets, which traditionally include precious metals. This created what economists call a volatility premium that supported precious metals valuations independent of pure fundamental supply-demand considerations. Third, the U.S. dollar declined roughly 8% against a broad basket of currencies during 2025. A weaker dollar increases the purchasing power of foreign investors buying dollar-denominated commodities like silver, effectively increasing global demand. Fourth, and most importantly, industrial supply chains continued to demonstrate genuine tightness. Manufacturers could not easily find alternative materials to replace silver in their manufacturing processes, which meant that price increases did not suppress demand in the way that traditional commodity demand curves would predict. For 2026, Pan American is guiding for annual production of 22 to 22.5 million ounces of silver and 735 to 800,000 ounces of gold. The inclusion of a full year of Juanicipio production, combined with optimization of the recently acquired asset, should support upper-range guidance achievement. The company has lowered all-in sustaining costs following the MAG acquisition, which means that operating leverage will expand if silver prices remain in the $40 to $65 per ounce range that has characterized most of 2025. Revenue guidance for 2026 is estimated by analysts at approximately $4.3 to $4.4 billion, representing roughly 21% growth from 2025. Earnings per share consensus for 2026 stands at $3.37 to $3.45, implying 56% growth from 2025 levels. These are not modest projections. These represent a continuation of the earnings acceleration that characterized 2025. The most important fact underlying this entire narrative is the structural supply deficit that exists in the global silver market. Deficit years in 2025 are projected by the Silver Institute at approximately 117 million ounces. This would represent the 5th consecutive year of deficits, with cumulative shortfalls now exceeding 600 million ounces since 2021. This is not a temporary imbalance that will resolve through relatively modest price adjustments. Every percentage point increase in mine production requires substantial capital investment with multi-year lead times. Mine construction, permitting, and development typically require 5 to 10 years before meaningful production comes online. Meanwhile, industrial demand for silver embedded in solar panels, electric vehicles, and data center equipment continues to accelerate. When supply is inelastic and demand is accelerating, the standard outcome is a sustained bull market in the underlying commodity. This is the context in which Pan American's share price has risen 119% year-to-date. It is not the result of a single quarter of outperformance or a temporary surge in metal prices. It is the cumulative result of a multi-year structural transformation in commodity markets. What distinguishes Pan American from many of its peers in the silver mining space is the combination of operational scale, geographic diversification, financial flexibility, and management quality. The company operates 10 mines across multiple countries, which means operational risk is distributed rather than concentrated. The company maintains a fortress balance sheet with minimal leverage, which means it can capitalize on opportunities that more leveraged competitors cannot pursue. Additionally, Pan American's acquisition of Juanicipio positioned the company to capture a meaningful portion of what many analysts consider the highest quality undeveloped silver deposit in the Western Hemisphere. This single asset provides optionality and upside optionality for the remainder of the decade. When you examine the numbers comprehensively, the 119% year-to-date performance of Pan American Silver is not a result of speculation or sentiment. It is the mathematical result of several intersecting realities. A genuine structural supply deficit in global silver markets, explosive industrial demand growth from photovoltaics, electric vehicles, and artificial intelligence infrastructure, a well-managed company with fortress balance sheet positioned as a Tier 1 producer, a transformational acquisition that acquired high-quality assets at strategically appropriate timing, and institutional capital redeploying from general equities into precious metals as interest rates decline and real yields move negative. The company is delivering record cash flows, raising dividends, acquiring growth assets, and generating earnings growth approaching 50 to 56% annually. The stock has risen 119% year-to-date, outpacing even the remarkable performance of the underlying silver commodity itself. If you found this analysis of Pan American Silver and the structural silver market dynamics compelling, I encourage you to subscribe to stay informed about further developments in the precious metals sector. The catalysts driving this cycle are unlikely to resolve in the near term, which means the next 12 to 24 months could deliver additional material developments. I read every comment and respond to thoughtful analysis within a reasonable time frame. Drop a comment with your perspective on what you think is the most significant factor driving Pan American's outperformance: the commodity price rally itself, the strategic acquisition of Juanicipio, the structural silver supply deficit, the Federal Reserve's rate-cutting cycle, or some combination of all these factors. I genuinely want to understand what resonates most with viewers as investors evaluate their own precious metals exposure. Thank you for engaging with this comprehensive breakdown. The precious metals sector will likely remain a central theme in financial markets for the remainder of 2025 and into 2026. Stay informed, do your own research, and consult qualified financial professionals before making any investment decisions of your own.